On the bean situation, this is the Jan report there. You can see this really tells the whole story on beans. You can see what happened was in December we had a 230 million bushel carryout. The market went into the January crop report thinking that we were also going to see another 230 million bushel carryout. And what happened was they lowered crush, they lowered exports, and we ended up with a 275 million bushel carryout. Well above market estimates, well above what anybody was really kind of looking for in this report. And frankly, 275 million bushels is just nothing that's bullish at all. It's not, I don't know if I'd call it overly bearish, but it's certainly not something that's supportive. And it really tells me that there's not a story in the soybean market. And when you look at the right side, the world numbers, what's interesting, we saw about a 1 million ton reduction in global stocks in this report. And that included 2.5 million ton reduction in Brazil and Argentina's production levels this year as well. So you can see, bottom line, some just minor tweaks to the world numbers, but the U.S. situation was where we all of a sudden realized there isn't a story in U.S. beans this year. And I think that was a critical move as well. The difference between the corn and the bean situation, and why the beans actually held in there pretty well following the January crop report, is that there wasn't as much exposure to the spec crowd coming out of that report. You can see in late December, we had one of the smallest net long positions in beans in history. They did buy about 25,000 contracts heading into the report. But generally, that's a token of what we normally would carry into a situation where we've got a bad weather problem in South America. Bottom line, that's a very small position to have when there's ever a growing problem anywhere in the world. So you can see there wasn't a lot of exposure there. Even more amazing, and think about this, open interest levels. These are almost 2-year lows in open interest. And if you think what open interest really means is that it's, I gauge how interesting a market is, we're at almost 2-year lows on bean open interest right now. And you look, they were basically liquidating positions as we started to go into December. It's just coming into the report actually. So you can see it's just a definite different exposure. People were getting out of beans. People didn't think there was a real bean story, and they were actually right based on what the USDA said. So really kind of a good lesson on, beans were only down about 25, 30 cents the day of the report. Corn was trading its limit plus. So you can see what market positioning can do to just price action coming out of one of those major reports. All right, that's what I wanted to start with, or just recap the Jan crop report. I do want to spend some time now to go over the 3 principal crops, U.S. and world carryout to use ratio charts. And I like carryout to use ratio is by far the most important fundamental stat you can look at. It takes the ending stocks level and equates it to the demand base for that year. So it's a true reflection on how tight or well supplied something really is. And what you see here is the 2011 projection. Again, that number in January, was it bearish in a long-term macro perspective situation? No, it's still the second tightest on record. And it's still going to be a tight situation going forward. It should be noted that the 2010 number at one point was down about there. So we eventually made that 2010 level rise a little bit. But right now, we're still projected to be much more snug than we were a year ago, and definitely the most snug we've been, even in the ethanol era. You take that one step further and apply it to a global situation, and it's even more apparent. We're currently projected to see the tightest all-time stocks-to-use ratio in world corn. Keep in mind, we've got a problem going on in Argentina, and that is only going to tighten that balance sheet up a little more as we go forward. Now, we've gotten used to something around this 15% stocks-to-use ratio. And I want you to remember that number. That's what global corn stocks, 15%. But you can see as it gets more snug and more snug, we're definitely in an unprecedented tight situation in worldwide corn, and that's something that we're going to have to address. On the other hand, this is one of the pathways out of here. World wheat. Now, I don't normally put much wheat in any outlook meetings that I do, and this year you have to, because it is the story, it is the way to satisfy all of those tight corn stocks that we've been talking about. As you can see, this is not carryout to use, this is just carryouts. But what I wanted to show is that you can see we've been rebuilding stocks sharply since 2007. We had a wheat problem back in the late 2000s. We lost a lot of global acres. All of a sudden, in 2007, we had a problem and we needed the acres. Wheat prices skyrocketed, and then we started rebuilding stocks. Wheat can be grown in almost any nation. It can be grown and harvested about 12 months of the year, so it's a very easy crop to kind of rebuild stocks in a pinch. What I want to point out is that we're projecting that little teeny difference between 2011 and 2010 represents 10 million tons of wheat stocks. That's 350 million bushels of wheat carryout growing this year. And wait till you see, we're having that much carryout growth despite what demand is for world wheat this year. You'll be amazed. It's just really a testament to how this market's solving our issues currently. Looking at the U.S. stocks-to-use ratio of wheat, down a little bit from 2 years ago, but still probably the second most well-supplied wheat market in the U.S. since 1987. What's interesting about wheat, U.S.-wise, is that look at what number we're talking about. We're talking about 40% stocks-to-use ratio. Corn, we're talking about sub-10 domestically. We've been sub-10 for quite a few years, off and on. Wheat's 40%. In other words, we can almost go another half year with just the ending stocks we've got now and satisfy the demand mix. It's an incredible amount of glut supply of U.S. wheat that we've really been building over the last 4 or 5 years. So you can see the wheat balance sheets are quite heavy. On the soybean side, excuse me, on the soybean side, this is what the report just told us when we got this 275 million. You apply that to the stocks-to-use ratio, and there isn't a story there. It's not too tight, it's not too well supplied, it's just in the middle of the road, and there isn't anything that really gets anybody too excited about it. That's why open interest is so low. That's why there's just not a lot of enthusiasm in the soybean market this year. And there really hasn't been as much over the last few years, but this year in particular. This is a chart that usually surprises most people. I think globally you think of world soybeans as a tight commodity. You think of them as something that's not got, it's just meeting its demand needs. We had all this demand ramp up, and you can see when that was in the late 90s is when really things started to really ramp up, and we had relatively tight stocks-to-use ratios. But since that point, since 1996, the trend of carryout to use has gone from the lower left to the upper right. And that's a surprising statistic. That's why when I showed you we had some losses coming in Brazil and Argentina in the last report, the market's just not overly concerned about it. We're still talking about one of the more well-supplied balance sheets worldwide, and it's just not anything that, yes, it's getting lower, but it's not getting lower into anything that's really representing a crisis mode in the bean market right now. So just summing up this 30,000-foot viewpoint, you have to know corn stocks are still extremely tight. We are now in our second consecutive year of rationing demand due to poor yields. I want to make sure that point is made too. It's been a yield issue. We hadn't rationed demand prior to last year until 95, 96, and we didn't know what prices it was going to take to accomplish that task. We are starting to find out what that is now. World corn stocks are also very snug and getting tighter. The world wheat and U.S. wheat, the world particularly, I want to focus on the world wheat situation. Those balance sheets are very well satisfied, and they're going to be called upon to help the U.S. balance sheet this year, the U.S. corn balance sheet this year. The world and U.S. balance sheets for beans, well supplied. There's just not a real story there right now. And unfortunately, I think this is kind of my three commodity outlook, is that corn is still the driver. It has been, it's going to be this year. It's the one that has a legitimate supply and demand situation. Wheat, however, is going to limit corn's potential. And we'll examine that further in the next couple of slides, and we'll really see the impact that wheat's having on the ability to take corn above, say, $6.50 and even $7. Beans are simply along for the ride. And if there's one thing you can take away, it's that the bean market is just along for the ride. And I even have a little picture to show you what I mean by that. The beans are the little dog in the sidecar of the motorcycle.